Hi everyone, we'll just kick it off now, I guess. It's kind of towards the end of the day. I know you're all anxious to go to the side events or whatever, have drinks. So my name is Elisabeth. I'm with SC Ventures. I'm on the investments team. As you may or may not know, SC Ventures, we are the innovation arm of Standard Chartered Bank. And we'll hear more about what we actually do as we have some representation from SC Ventures as well, from a 2.0 and a Web 3.0 perspective. And then, sorry Charles, it feels like we're ganging up on you here, but you're from UOB, but I'll leave it up to the panelists to introduce themselves.
Thanks, Liz. Hi, everyone. I'm Alex, and I look after two of the funds under SC Ventures. So first, we have our first fund is a 100 million fund that invests in fintechs that the bank works with. And the second de facto fund is really our balance sheet of both the bank as well as SC Ventures. So that fund looks a lot at more opportunistic startups where we think they may affect the future of banking. Gakim, over to you.
Hi, I'm Gakim. I look after the digital asset fund. In addition to that, I'm the operating lead for all of the digital asset ventures at SC Ventures.
Hi, good afternoon, everyone. My name is Charles. I'm a director at UOB Venture Management. So UOB Venture is a venture capital and private equity arm of UOB Group. And at UOB Venture, we manage an umbrella of different venture cap and private equity funds, focusing on different sectors, different mandates. Specifically for myself, I look after a Web3 venture capital fund that invests in startups globally.
All right. So why don't we kick it off with what is actually Web 2.0 and 3.0? What are the key differences? And maybe, I don't know what the audience is like here today, but I assume there's a bit of a mix. So explain like I'm five, and what is Web 2.0 and 3.0, and maybe Alex start, or whoever wants to kick off. There's already a battle between 2.0 and 3.0.
Alex can start.
I'll just cover the easy ones, right? So I'll let Hakim define the more difficult ones. So I think Web 2.0, it's really anything that's not Web 3.0, right? It's simple enough. So I think Web 2.0 is everything that we've had to date, right? Everything that is SaaS, everything is AI, anything that's really not Web 1.3 that doesn't touch into blockchain or touch into new technologies like the metaverse, I would define that as Web 2.0. Although I guess in the last 2 years there's been a lot of diffusion and confusion between the two. So there's a big emergent space of Web 2.5. I think that's probably where a lot of the deals are being made. But Hakim, what's your view of Web 3 and how does the fund, right? What's the fund's mandate for our digital assets fund?
So the fund has a mandate across digital assets broadly, which includes market infrastructure all the way through to tokenization, and then pretty much anything that touches the space, beyond that, NFTs, etc., and so forth. There's a small pocket which is available for token investment. What we're seeing is that in the market infrastructure space, there's a repurposing of the market infrastructure that's taken place, and that's been driven by the fact that digital asset market infrastructure provides an opportunity for capital markets to retool the way infrastructure looks, and that's everything from clearing, settlement, trading, and also venues in effect, and the underlying technology that effectively drives traditional market infrastructure. So we're seeing an evolution that's taking place in the capital market space. And that evolution is one which is not sort of immediately from state 1 to state 2. It's an evolutionary process. And more particularly, I think what's topical fairly recently is the evolution that's taking place in the payment space, where you've had traditional payments rails being run by Swift, for decades and generations. Stripe's acquisition of Bridge is pretty much signaling an end to where that traditional infrastructure is effectively shifting over to digital asset-based rails. So there's definitely a transition which is taking place. We're sitting in that transition space right now, and that's where a number of opportunities effectively lie, where efficiencies would effectively be be realized out of utilizing digital asset infrastructure that is beginning to show early signs of maturity in that regard. And one of the major differences that we see, Web 2.0 businesses, if you exclude maybe payments and a few other spaces in the capital market space, digital assets generally, there is a wide open space to create new things. But at the same point in time, what's challenging that we see is that regulatory environments need to catch up in that space. And that's always a challenge and always a risk, as we've seen in the US, a number of parties have been put under the microscope by the SEC and other regulatory bodies in terms of the activity that they have there. So definitely there's, in the Web3 space, there's definitely a case of the regulatory environment needing to catch up quite a bit. So what's interesting is, from an institutional perspective for us, because we've invested, the fund that Alex manages has largely been in enterprise technology and software. There's less of a regulatory sort of touch point with respect to that. Also, what we're seeing is, in Web3, it's more community driven. And the reason why it's more community driven is because, and that community can be individuals, that community can be institutions and corporates. And the reason why it's more community driven is ultimately these technologies are very focused on ensuring, when they develop, that there are use cases, that there are people that are using them in that respect. So having strong communities is hugely important from a catalyst perspective, where there's a big difference in terms of the way the technology is being designed, in terms of the way the protocols are effectively being designed. It's heavily focused on whether it's a developer community or community of users. So those, top of mind are, where we're beginning to see the transition, but also where we're beginning to see the differences in the space as well. Charles?
Actually, I think Alex and Gakim have covered it quite nicely. I think for me, I just add that actually right now, if you look at the whole evolution of Web3, we are still in very early days. As a percentage of total global population, the penetration of Web3, people that actually own digital assets, just 7%. So you can imagine, compared to the internet penetration today is at 70%. So that's like a 10x opportunity growth out there. So I think even though we talk about like Web3 being around for like the past 15 years, right, actually we're still in a very early stage of adoption, and there's still a lot of massive opportunities. And as what Gakim mentioned, there's a need for regulations to come in, provide more clarity, more confidence for retail investors to come in. For us as institutions, right, us coming in, deploying capital into this space, also lends certain credibility and confidence to market participants. I think there are a few drivers that need to come in order to take Web3 to the next growth phase. Yeah.
I think one of the things that I just want to add as well, to Charles's point, is the aspect and the element of inclusion. The nice thing about digital assets is the technology is positioned in such a way where it is beginning to make instruments, tools, experiences that were previously, and even instruments, whether it's for investment or alternatively art, NFTs, it's beginning to make ownership of things easier. It's driving inclusion of the masses, not only into being able to access financial instruments, being able to access ownership, but it's also opening up, from a community perspective, it's opening up opportunities to the masses. If you had to talk to individuals in the Web2 context of, have you got exposure to a SaaS company? Do you understand what a SaaS company does? Do you understand what a cyber company does? Versus if you had to say to somebody, do you own a Ethereum? Do you own a Tom token? It's very different. So this sort of proliferation of technologies has resulted in mass movements of individuals becoming a lot more engaged and involved and included in just being able to access so much more in a way which is not fraught with barriers that existed in the Web2 context as well. And that's hugely important.
So what about in terms of, because we're all investors basically right here, like from a deal pipeline, what is it that you're seeing most? I know even though you have a specific focus to 2 to 3, etc., but is there any like in betweens, like 2.5, that you would consider putting into like a 2.0 fund, or vice versa? And what is it that you're seeing in the market these days?
So actually we launched the fund back in 2021. That was actually during the last so-called bull market. So at that time, I remember there were a lot of hype around L2s, followed by NFTs, the DeFi summer, and then ZK and things like that. So actually the whole space, innovation actually moves very, very, very quickly. The trends move from one to another in a very short period of time. So for us, when we look at an investment opportunity, we try to look at it from a more sustainable point of view, not so much chasing after short-term hype, but really looking at the business and seeing, who is the team behind it, whether this business itself is sustainable, whether there's a real tokenomics protocol, if it's a protocol, whether there's a sustainable protocol revenue generation capability. And of course, we look at whether the valuation vis-a-vis distraction makes sense or not. So I think whether we look at it from whether we evaluate a company, whether it's from a Web2 perspective or Web3 perspective, actually the fundamental factors are more or less the same. I think the biggest difference between a Web3 and a Web2 project is really where the token component come in. Because actually token is just an easy way for a project to actually bootstrap and to be able to raise capital quickly and to get to market more quickly compared to a traditional Web2 route. You go through series A, B, C, D, E, and then you raise many rounds from various VCs before you can actually get to some level of traction. Whereas Web3, you just leap across that chasm, right? So I think that is actually the critical part of it. So when we look at a Web3 project, we spend a lot of time looking at their tokenomics design, whether there is a good supply-demand tokenomics behind how the whole protocol is designed. Yeah. In terms of like Web 2.5 companies, I think it's quite challenging to actually define what is a Web 2.5 company. To be very honest, I think if you look at Web 2 companies, it's P&L driven. For investor point of view, we are looking at whether the ownership in the shares of the company can actually deliver value for shareholders. For Web3 projects, we are looking at tokenomics, whether the tokens that the investor receive, the value can accrue these tokens. For Web 2.5 companies, actually we find that a lot of times companies that are trying to raise in a 2.5 kind of concept, right, they struggle between trying to accrue value towards equity or towards a token. So even as a VC, sometimes for us when we look at such opportunities, we are a bit more cautious, and unless the project is able to very clearly define, okay, how are they going to accrue value across the two, I would say a Web 2.5 in that investment structure point of view can be quite tricky.
Anything to add, Alex? What about in terms of like underwriting the investment? Is it a different way that you look at a traditional Web 2 company or versus a project, like in the valuation metrics? You mentioned tokenomics. I mean, anything that you would say this is purely for this type of company, and then we would change it completely if we looked at another project, for example. Maybe we'll start off with Web 2.
Yeah, start off with the much easier one. So I guess in the standard way to evaluate a startup would be market size, the people, and the product, right? I think you go to any VC 101, that's what they tell you. So that's how we typically do it at a fund, whether the market size is large enough. And I think the standard number that Silicon Valley would tell you would be 20 billion. So if the startup I invest in hopefully has 5%, I have $1 billion revenue. It's purely because it's really cool to say they make $1 billion in revenue, right? And in terms of people, of course, lots of things. It's a gut feel. There's a lot of different ways that different VCs define how they evaluate the people. But I think for us, we take a mix of experience as well as coachability. So someone that has been in the space, knows what's going on, but still humble enough to say that, sure, you've been global head and you had 2,000 people under you for the last 20 years, right? But you might not know exactly what you're doing. And here, there's a team here that's trying to help to guide you and coach you, give you a little bit of feedback. Do you take that? Well, so we've seen extremes of both, and hopefully all founders in our portfolio companies do have the right mix of humility as well as a bit of, we'll call it arrogance, to know that they can go to the table and close a deal, and even though they are a startup, still pretend like they are still running a $500 million company. And the last is of course the product, and that's simple enough. And when it comes to us, is it really working, and how unique is it? What's the USP and how defensible it is? So that's pretty simple, but not sure how you would evaluate a Web3 company if it's early stage. Over to Gakim.
I think one of the differences, a lot of the technologies, if you just put aside market infrastructure in the space, a lot of the technologies, they come with a decentralization component. And within that decentralization is also an element of governance as well, that comes with that. Historically, there are a lot of projects that have been, from a governance perspective, structured in a way which make them complicated. And by complicated, I mean there ends up always being a group of people that effectively control governance tokens, that effectively have an agenda, etc., and so forth. And depending on who fights with whom, and then all of a sudden those dynamics effectively change. So those are dynamics that we have to deal with when looking at a lot of the Web3 projects, is trying to understand the robustness of the governance model, the risks of the governance model, and to what extent those governance models that are constructed off the back of smart contracts either provides a risk or alternatively provides you a significant upside. So that's an open area that I think a lot of investors are still trying to apply their minds in terms of how to effectively protect themselves. What's clear is that opportunities from a trend perspective, what we're seeing is where there are hybrid opportunities where there's equity and tokens involved, the ones that have generally fared a lot better are the ones where the founders have built, raising equity first, understood the key basic MVP use cases that they're wanting to effectively lead with. Tokens has effectively always been part of the roadmap, but ultimately what happens is that the token bonus effectively comes later down the line. Once there's effectively good long-term commitment in the infrastructure that's effectively been designed for the token to essentially operate within. What's happening in the more extreme end of it is you speak to any of the large tier 1 investors in the US that are not necessarily strategic investors, the way that they look at token projects right now is they look at it purely from a financial perspective rather than from a use case perspective. They look at it as a way to effectively leverage their multiples of their money in that respect, rather than saying, are we actually going to be long-term holders of the token? Are we actually going to be users and promoters of the ecosystem versus dumping it within the first 6 months, once we effectively get it in? So there's that moral hazard that, a number of investors, still need to reflect on, in terms of their investing style that they basically have. Yes, there's an opportunity in these businesses to demonstrate prolific and significant growth relative to Web 2.0 businesses, but ultimately as investors, we need to, when we are supporting these companies, if we are recipients of tokens, we need to behave in a way which is also responsible, that also shows that we are committed to supporting those ecosystems in the long run, rather than effectively just receiving those tokens and within days afterwards effectively dumping it on the exchange so we can realize an MOIC. So those are some of the challenges that we see where the industry still needs to potentially grow up and understand what good looks like.
So in terms of the industry, do you see a lot more collaboration or more competition between these two? Like, because there's so much that's coming out in the Web 3.0, any involvement that you think the Web 2.0 are trying to maybe see, adopt, and maybe learn from even?
Yeah, actually, currently we are already seeing a lot of corporates that are looking at Web3 technology and looking to see how to integrate and use blockchain technology. So like we give a few examples, like you look at X, PayPal, they are already supporting cryptocurrency on their platforms. Corporates like Starbucks, Nike, Adidas, they're introducing NFT loyalty engagement programs. I think as Gakim has mentioned recently in the news, again Stripe also acquired Bridge in quite a large M&A kind of acquisition move. So we see a lot of this, actually over time we have seen recently a lot of these M&A, Web2 companies looking at Web3 and looking to see how to reap the advantages of blockchain tech. And even for us as financial institutions, banks, I think over time we'll start to bring some of these wholesale banking transactions on chain as well, because we recognize the benefits of it being cheap, fast, and secure, right? So I think we are seeing this move towards Web2 companies looking at Web3. It's still early days, but we're seeing already a lot of these early movements. And specific to to us, UB Venture, actually recently we invested in a company. It's based in Singapore, and it went into a joint venture with Sony Group, one of the large corporates in Japan, right? And what Sony is looking to do is to actually build a blockchain network with use cases in gaming, entertainment, IP, identity, financial services. For Sony as a group, they have many business units, and they have been thinking about, okay, how do I bring some of these businesses on chain and to actually realize more of this value out of my individual business units. So they thought of building out their blockchain network in collaboration with this company in Singapore called Startail. And there is actually significant use cases that Sony Group can actually bring about onto the blockchain. So this is just one example that we're seeing, not just globally but specifically to Asia, right? That some of these corporates are really looking to see how to integrate and bring about blockchain tech, Web3 tech into their businesses. Yeah.
I think one of the things that's been relatively, I won't say unique, but for lack of a better word, unique about SE Ventures as a platform is we've always been focused in working with partners, be they clients or be they corporate partners. There's certain things that we think we do well, and there's certain things that partners effectively bring to the table. In the context of Web3, we have good base infrastructure that we've either invested in or built, but ultimately, if you look at be it tokenization, prime brokerage, there are partners that could support distribution, there are partners that could support risk capital. So really having an approach where one's working with partners ultimately means that the corporate ecosystem then starts collaborating with other corporates, where they re-establish those value chains which existed in the Web 2.0 space. So for example, if you look at bank assurance, banks and insurance companies lived together for decades, where banks would effectively act as distribution agents for insurance-based products. So in the context of the technology evolving, the question is, how do those corporate partnerships reevaluate the parties that they work with in light of those value chains re-establishing and re-engineering themselves from a plumbing perspective. And we're seeing a lot of that evolution taking place, where new partnerships are being struck, unlikely partnerships are being struck, where people we thought would never ever work together end up working together in that respect, simply because a lot of corporates have just taken an early view, a pioneering view, whether it's in AI, whether it's in digital assets, to get stuck in, invest early, and off the back of that, bring their organizations to a point where, from a knowledge and a capability perspective, they're well positioned to be able to understand the technology, where to apply the technology in many ways. And those corporates that have taken that leap of faith to be able to make that investment early on, they've generally become more attractive from a DNA perspective to work with others who are maybe looking for those capabilities, or corporates that don't necessarily have those budgets or deep pockets, or the sponsorship to necessarily invest as broadly for that matter. So that's an area where we see a lot of activity and opportunity for us to work with other corporates and other partners for that matter.
In summary, I just say more collaboration and competition, and I think of it also as the involvement of the Web3 space, right? What is presents itself is a lot more new opportunities to sell to. Like for example, some of our portfolio companies, there's one we have called Check that does KYB. Besides selling to large corporates, large enterprises, and SMEs, they now have a whole new market of people to sell to. Because guess what? Web3 companies also need KYB. So they've added a lot of crypto VCs to their firms, right? Crypto asset managers just overnight. So yeah, I think a lot more collaboration.
Okay, that's good to hear. So zooming out, there's a lot of things happening in the world. I mean, there are some ongoing wars. There's the election that's, I think, in 24 hours or something. So what is the current investor sentiment now? What do you think it's going to be? What is your prediction that's going to happen in literally 24, 48 hours? Because it's interesting, right? Because you have two different political parties. One is kind of for, against. I know you're smiling, Gakim, but yeah, why don't you kick it off?
So I'm not going to be giving any advice for anybody to necessarily be applying on Polymarket.
Too late.
So whatever I say, please don't apply to Polymarket on your bet. Look, I think in the context of the US, there's definitely going to be some change that takes place. I think that change from a regulatory perspective, it's inevitable. I think the balance has been tipped, given the fact that there's a momentum which is building significantly. I mean, if one just takes a look very simply, in the last week, you've had record inflows into BlackRock's Bitcoin ETF. Just use that as an example. If you take a look at layer 2s, how the layer 2 protocols are effectively maturing from a use case perspective. If you look at the TON ecosystem, the amount of new applications that have launched in that from an ecosystem perspective. So will the elections play a role? Will the political environment play a role? For sure it's going to play a role. And it's really going to be a function of the types of policies that we hope. There's been a lot of signaling, particularly from the US, and many parts of the world ultimately, follow suit in terms of where the US positions itself in a lot of sort of policy and regulatory type decisions. What does that ultimately mean? It ultimately means that more capital will flow more easily into certain spaces, and that might potentially be Web3. More parties would feel more confident, making investments, in those spaces over time. But that we effectively looking at the backdrop of uncertainty with respect to equity capital markets that have been under pressure lately, for that matter. But I think those are short-term events. But ultimately, if one looks at it from a long-term perspective, there's a momentum that's building. There's a momentum in terms of adoption that's building in terms of Web3. And that adoption is not necessarily adults only, it's children. The adopters are effectively getting younger and younger in that respect. Part of, I think, where we see interesting opportunities is there's still large open spaces where either, from a regulatory perspective, there's an opportunity to step into and build capabilities, build infrastructure. So for us, that's exciting off the back of a backdrop where we think there's almost an overwhelmingly positive sentiment from a regulatory perspective that's likely to manifest.
I agree with what Gakim has mentioned. I think for Web3 investors, actually sentiments are pretty much driven by a few factors: regulation, cyclicality of the industry, as well as institution adoption. So as what Gakim has mentioned, I think with clearer regulations, more regulations coming on board to tell people how these digital assets should be treated and governed, right? I think that will give the retail, the community, a lot more confidence to come in, and naturally, the investor sentiments in this market will improve over time. So I think regulation is probably the #1 driver for investor sentiment for Web3 going forward. Of course, the other one is looking at how much institutions are actually coming into this space. Earlier this year, we saw like the likes of BlackRock, Fidelity launching Bitcoin ETFs, and that actually drove a lot of positivity among the investors and obviously drove the prices up as well. So I think institutions coming in, lending credibility and trust to the system, to the overall digital asset industry, certainly would be very favorable for investor sentiments. And I think the third one is obviously for Web3, as we all know, is cyclical in nature. In a bull market, the last bull cycle, we saw a lot of enthusiasm around NFTs, DeFi, etc. And that also drove a lot of new investors into the market. And on the other hand, when the bear market hit, FTX, Luna crashed, that also drove a lot of investors out. So I think there are a few key factors at play, particular to Web3, market regulation, and macro cyclicality of the industry that generally determines investor sentiments. Yeah.
I guess for Web2, just normal, right? VC is part of the financial markets, a niche part, and we are probably lagging 18 to 24 months behind. So the last time when interest rates were terribly low globally, I think investors raised a record amount of money. Post the rise in interest rates, I think the amount of money that LPs have given to VCs as an industry class has cut down by about a third, a quarter. So I think it really depends how who wins and how the financial markets go. Don't forget that VCs also raise money from LPs. So if the financial markets on a whole are great, I think there will be a lot of money raised by VCs, which will go into startups eventually. But don't forget, it's always a 18 to 24 month cycle.
So we talk about kind of like the sentiment, the entry, and all that. But what about the exit? So the IPO market has been dried up quite the last few years, and some are actually going to IPO as well, but it's not as hot as we had anticipated. So is there a difference when we look at it from a Web2, Web3 point of view in terms of exit and actually getting some money for our investment?
I think the difference with Web3 companies is that they've innately been designed to address those sorts of issues. So tokens are freely traded on exchanges where there's decent amounts of liquidity. With the advent of tokenization, equity positions in privately owned companies, at some point, the efficiency around trading up those positions, not being so illiquid, over time, the next 3, 4, 5 years, as you have the real world tokenization boom, I think the possibilities around exit then begin to change fundamentally in that particular context. Having said that, over the last 2 years, you've seen investors pulling back in the venture markets, focuses on pathways to profitability. There's been sort of early indications that the weaker entities that have not executed particularly well, either they folded, there's cost cutting taking place, and inherently there's been an environment where M&A is effectively rife as well. So I think that's set to continue, but I think for the Web3 companies, they generally do have a lot more possibilities in terms of accessing liquidity, but also being able to manifest exits differently. Just given that they view differently and they can be listed on alternative exchanges and so forth.
So I think generally right now for a Web3 investor, the primary exit route is via token listing and exit and the sale of the tokens, right? But I think I think that will change over time as well, given that regulations coming in, industry matures. I think right now it's not that a lot of the Web3 companies, they don't want to take the IPO route. I think as Liz mentioned, first of all, the capital markets have been shut, not just for Web3 but Web2 companies in general, but also there is the regulation uncertainty. I think the last successful Web3 company that went IPO is probably Coinbase, and even for Coinbase right now, they're under so much SEC scrutiny that other Web3 companies are looking at Coinbase saying, should I go IPO or not, and be subject to all this scrutiny, right? So unless that change, regulations improve, I think Web3 companies are still on the sidelines and looking at the right time to actually tap the capital markets and go for an IPO. But I feel that would change over time as regulations improve and the industry matures. I think the other exit route for Web3 investors is obviously buying a trade sale. Like recently we saw like Stripe acquiring Bridge, right? That is a classic example of exit by investors through a trade sale. I think over time as the industry consolidates, we will see more and more such opportunities.
Nothing much to add. Basically, Web3 investors, so Gakim's fund has a lot more ways, has one additional way to exit, right? Via tokens, if you invest in tokens, as compared to the traditional route.
Okay, so at SC Ventures we have several verticals, as you may or may not have heard early in the day, but one of them is sustainability. So does sustainability look differently when you invest in Web 2.0 or 3.0 companies?
So one of the interesting things that has been sort of relatively topical in the Web3 space is if you look at protocols that are proof of work driven, increasingly a lot more going to proof of stake. But if you look at Bitcoin, there's been significant amount of chatter with respect to the amount of energy that it effectively takes to mine Bitcoin. There are various ways from an ESG perspective, and there are a number of initiatives and companies that are currently utilizing alternative energy sources in order to drive down the energy costs from a mining perspective. So there's opportunity to bring those sorts of elements into the equation. Then overlapping in the Web 2.0 space, there's the amount of energy that's effectively taken up in terms of data centers, particularly when it comes to AI and the expansion that's effectively taking place there. So the alternative energy space, being able to be a source of support that drives and powers both the Web3 and the Web2 industries, I think over time, there will definitely be a far closer relationship that begins to establish itself, at least from an energy sustainability standpoint that we see. But in addition to that, there's also a crossover point from an industry perspective where both Web3 and Web2, there's a hardware reliance point. And from a hardware reliance point, then it's a question of the hardware that's effectively being deployed into the proof of work infrastructure from a circuit board perspective, or alternatively data centers that are being built. Then it's a question of to what extent that's being built in locations where, from a labor perspective, labor is being sourced ethically. The raw materials that are effectively going into the hardware is being sourced ethically, from a value chain perspective, et cetera, et cetera. There's significant pressure, to be competitive, when it comes to input costs, whether it's data centers, whether it's mines, or whether it's, in manufacturing any of the IoT equipment, or any of the hardware for that particular matter. It's definitely making its way in, and there's a lot more awareness in terms of what businesses need to do, when it comes to that.
I think the way I look at ESG is what requirements are being driven. And in EU is already for investors, there's already a segment of reporting that you have to do. So I think there have been certain investments where investors in Europe who want to invest in but can't because the company doesn't meet certain standards, and that drags down the overall portfolio ESG reporting, and basically the LPs will just pull out. I think in US it's an interesting space where some have actually moved backwards from very ESG driven to no, we don't want to have anything to do with ESG. But I think in Asia, we all can only see it being more regulated. So I need to say we need to have more consideration towards ESG when investing. And I don't think that's gonna go the other way.
So we do have, thank you for all the insights. So basically the takeaways were kind of hedged, and the market has kind of priced in the next couple of days events. Okay, so we do have 10 more minutes, and I would like to open it up for questions. Yeah, because I knew there would be some. Do you want a mic or do you want?
What's better? I think that I don't.
Yeah, I think we can hear you, right?
Oh, thank you very much. First and foremost, Michael Riha.
I think it's going to be better with mine.
Yeah.
Okay. Fair enough.
Well, thank you. Michael Riha from Tantabanka, Slovakia. I've got 3 questions, and they are somewhat related, if you don't mind. So my first question would be, you mentioned governance at the beginning of crypto projects and tokenomics. Is the governance going the right direction, or the one direction, as you said, necessarily bad? When we look at the biggest companies on this planet, they've been built having closed-end governance models. And that leads me to my second question. You also mentioned SWIFT, and it's something also we think about that might change, is who should actually be the driving force of changing the infrastructure? Should be central banks, corporations, or public projects, because we see all of them that they kind of experiment with projects or run their own. And does it even matter? Should we just build bridges between those projects? Is that the solution? And lastly, a bit of devil's advocate question is that in terms of quantum computers and risk of public chains hacking private wallets and exploiting tokenomics in terms of mining, will this force the infrastructure to run on closed infrastructure secured by quantum generated keys? So at the end of the day, will we end in, let's say, of the government-led hands, shall we say? Thank you.
Good luck.
Yeah,
I think let's start at the first one from a governance standpoint. I think, in order for governance to be effective, there always needs to be a legal nexus that it effectively ties back to. And what you see playing out in the context of, call it DAO type infrastructure from a governance perspective is, governance in a DAO construct is effectively driven by rights, which are attached to a smart contract, which is attached to an instrument, and that's effectively automated for that matter. What is clear, though, from a governance standpoint, is that projects need to have a group of members, be it organizations or individuals, that are effectively driving the objectives of that particular project, be it a protocol, be it a business, for that matter. So you're always going to need to have sponsors and promoters that effectively promote those projects. But in the context of decentralization as a concept, it's fantastic, but that ultimately needs to link its way back to a level of enforceability in a real world context for now. Will we eventually in the next 10, 20, 30, 40, 50 years get to a point where you have complete decentralization? Probably not. Will there be elements of governance, be it voting, etc., whether it's sponsors and or the community, that effectively gets done over time in the context of smart contracts in a DAO construct? Yes, you would. So I foresee us living in a hybrid situation where parts of businesses or projects would effectively be governed in a hybrid context, where certain decisions can be made on the basis of decentralization, but ultimately, in order to tie that back to a legal construct which is enforceable, those governance models would effectively still have to tie back to real-world jurisdiction type of accountability to an actual legal framework in a particular country for the time being. Does that answer your first question?
Yes.
Okay.
And maybe pass it over.
I think the second question, can you just refresh?
The second one was regarding Swift and
Okay.
whether it should be corporations, private projects, or actually a government.
I don't think it's necessarily one size fits all. I mean, what we see on an ongoing basis, whether we're building businesses with other corporates, institutions or bodies, or whether we're building it, with partners that are individuals, each project then is trying to address a specific problem at the end of the day. And what ends up happening over a period of time is that certain industry utilities and projects generally end up building a momentum much faster than others, because they're just able to effectively address a problem statement or a series of problem statements more efficiently than other competing ones over time. So you'll generally have the free market forces take over that ultimately will decide what the best combination of ownership effectively is to be able to address certain problems for that matter. So I don't think it's a case of mandating that certain things need to be done or owned by certain parties. Traditionally, in a DeFi type context, industry utilities have worked exceptionally well because they've helped participants to rationalize the amount of capital that they're spending to be able to address a particular problem statement. But I think in the context of the DeFi community, that ecosystem is a much bigger ecosystem, where you actually have Web3 players working in conjunction with corporates to be able to solve a problem. So I think the ownership pool and profile is going to change. Lastly, on the quantum computing side, private versus public chain, different use cases. What we see is public chains and private chains, they'll exist for very specific use cases. Institutions typically, if you look at the trilemma issue in terms of the scalability, the speed and security, whoever can solve that ultimately, that's going to be the one that sort of rules them all in that context, and that party and protocol hasn't emerged as yet. However, from a regulatory perspective, there are certain use cases that corporates would like to enjoy a level of speed and privacy. So for those use cases, what we're seeing is that those use cases would effectively stay in a private chain context. Then there are other use cases that need the transparency and the scalability that the public chains effectively provide in that particular context. So we see both instances, private and public chain, remaining, but there will probably be an instance where there will be bridges, interoperability bridges that will be built between both the private and the public chain environment in that particular sense. Does AI and quantum computing effectively pose a security risk? There's always a security risk, when it comes to these sorts of things, but ultimately what we're seeing is there's a series of tools that a number of organizations are effectively developing from a monitoring perspective, where they're able to hit off the types of risks that you're referring to, to provide the necessary safeguards and so forth. So I've done, I've tried my best, but I hope that's meaningful. But Alex, Charles, please feel free to weigh.
And maybe I just add a bit more to the question about governance, because I think that's also an area that we spend a lot of time looking at. Because if you look at governance, actually even, let me take a few steps back, looking at Web2 companies, actually governance itself is quite hard to enforce. Because at the end of the day, company is managed by a majority shareholder, a founder, his team, and how he governs the company, what kind of operations SOP he uses within the company, the kind of financial engineering that he can do. Actually, if he maliciously wants to take certain actions against the shareholders, he can actually do that. And it's quite hard, even as a shareholder, to be able to enforce those governance issues. The good thing about Web3 is that because it's decentralized, everyone can see all the votes are being voted and put on a smart contract on chain, everyone can actually verify. Actually, it does resolve a lot of these Web2 traditional governance issue. So recently, actually, we came across a company that is trying to make governance voting even fairer. Because right now, if you look at how votes are being done, actually, a lot of times at least that's what the company shared with us, right? A lot of times the ones that hold the major votes, they are the ones ultimately deciding. And a lot of those smaller so-called token holders, right? They will look at what the big guy is voting and they follow the big guy so that they don't seem to be going against him. So at the end of the day, it becomes a self-fulfilling prophecy. The one with the largest vote always get the say in the end. So how do you make the voting more transparent? I think that's the question. So this company is trying to add a privacy layer on top of the whole voting mechanics to make it fairer. So no one can see who is voting, which wallet is voting what. At the end of the day, there's only a scorecard. Okay, this is the final result. So I think the way that protocols are being governed right now, we are still in a very early stage. I think there's still a lot of room to actually make it even fairer and more transparent.
Thank you.
Any input, Alex, from you? Okay. Do we have any other? Okay.
So, I mean, given the theme,
Maybe easier.
right? So, given the theme of investment, Web2, Web3, what you said earlier about tokenization, question on liquidity, right? Liquidity in Web2, Web3. Seems to me that liquidity is moving around a lot, but it's all on chain, so it can be observed, right? Meme coins, right? Really popular, sucking liquidity out of the market, very dynamic, pretty manipulated. Okay, it ties to tokenomics. I mean, what is the future of this? Is it all going to Bitcoin? Is it going to meme coins? What's the future of the liquidity of the on-chain analysis, which can kind of give a bit more insight? You know, there's a Singapore company called Nansen, which have got insight into many different protocols, including Solana right now. So really the question is quite broad. Answer it as you wish. What is the future? You don't have to name the tokens. Is it all going to Bitcoin, meme coins, or how's it going to stabilize? So many questions.
Again, not investment advice, right?
Yeah, I think that's a very good question. Actually, if you look at it statistically today, crypto penetration is only 7%. So that liquidity is within this 7%. In order for the liquidity in the market to grow, this 7% needs to become 70%, right? Then you have real liquidity in the market. Right now, you're seeing a lot of liquidity flowing from one vertical to another, Bitcoin to meme coin, Bitcoin to DeFi, etc. It's because that liquidity is all the same. It's the same pool. It's you and me trading against each other. I think what we need is the next billion crypto users to come into this ecosystem in order to really drive even greater liquidity in the whole market. That, as well as institutions with much larger capital deployed to come in to give it that liquidity boost. This is my 2 cents worth.
Yeah, I would agree with that. I think in order to bring more liquidity, you need to bring more institutional grade capabilities. Otherwise, you're going to keep on seeing what you're describing. And I go back to what you were saying as well, which is unless there are more regulations, unless we have more visibility and more clarity around that, institutional players simply, it's very hard for us, for your institution that enables the IPOs of the market, that enables institutional players to come in, you're not going to see much more liquidity level.
But also the type of instruments, the instruments will expand over time. As real-world asset tokenization takes off, as the distribution of real-world asset tokenization infrastructure takes off, you will have a lot more than Bitcoin, Ethereum, and meme coins to pick and choose from at that point as well. So that will expand over time.
All right, thank you so much for your participation and also your attendance today, and I hope you enjoyed it. Thank you very much.